Tools are great when the AI is part of your team, for real, not VC talk. The amount of revenue that it's accessible is so high.
Sell shit to the people who are making AI, and if they grow, you'll sell more shit too.
You just can't take that early first month explosion as seriously as you used to. It's not as defensible.
The pace of evolution is so fast. If you decide what I knew 6 months ago is still useful, you're probably going to be wrong very quickly, right? That's what I find the most stressful about right now.
Ready to go?
Guys, it is so good to be back with you. I've just come back from my AGM, and it's a humbling thing for me because for 10 years I did this show solo, and then I go to my AGM, and do you know what everyone says? Oh, we love Rory and Jason. We love Rory and Jason. And I suddenly realized that I wasn't the star of the show. It wasn't that.
Just kick us off. End this now.
Well, okay, fine. I'll kick us off with big venture news. We've said before about, Sequoia being the kings of venture. Leadership transition at the top. We saw Roelof Botha moving out as steward after a 3-year tenure and being replaced by Pat Grady and Alfred Lin, which was, I think, quite surprising news to the venture ecosystem. I'd love to hear how you thought about it. And let's start there before I lead the witness.
It just brings home how tough venture is right now. This is the best firm in the world, and they're feeling with what's going on in AI that they're behind, right? And, let's be honest, I would say all of us are, I think everyone in venture, especially if you have both a large existing portfolio and you're trying to compete, these new deals in the last 3 years, everyone is feeling stretched. Everyone is feeling tired. Everyone is feeling it's brutally competitive. And, sometimes, this is going to sound it's not schadenfreude, but it's more reassuring in a way. I get up and I go, God, we need to do better. We need to sort this out. And then you realize the best firm in the world is having exactly the same feelings.
Why do you think a leadership transition is showing that they're behind in AI?
Look, whenever you have a CEO change, in a venture, it's because something is wrong, right? And again, if you want to kind of go down in the weeds of the interpersonal stuff and people's perceptions of other people, we can talk about that later. But my outside-in reading is, in part, this is dissatisfaction about how the firm is doing relative to the competition. Look, I'm not saying they are behind. I'm saying there's a perception internally that they could do better. They missed some rounds and some deals. They passed in some great companies. That can be frustrating. When you're top dog and you feel for whatever reason that you're not quite performing at your best, it can be frustrating.
Well, maybe two thoughts. One is, it's just maybe in general, more people should be stepping aside today. I think more people, VCs, executives, founders, and I'm not saying this is exactly what happened at Sequoia. That's the articles, right? It's about AI and missing cursor and missing these deals. Maybe that's true, but I just think the most folks from the last decade or 15 years are not the right people for the next decade. I genuinely believe it across my ecosystem. I struggle to even recommend a lot of the CROs and executives I know for roles today. I just struggle to find them a job. They're not the right people anymore. And so I think I could only imagine we don't even need half the VCs we have today for the AI world. Maybe they'll spend the money. Maybe they'll throw a few nickels into Cursor at 30 billion, get a few logos on the website. But the old playbook don't work. And the pace is so fast. Take your coins, take your NVIDIA shares, and buy a beach house. Seriously, check out. It's a good time to check out, guys.
One of the things I admire most about Sequoia is their toughness and their willingness and ability to evolve, right? And in this case, I'm not commenting on the merits of the case, but if the internal group, because I don't know enough, right, to say was it Roelof or something, but if the internal group feels they need to make a change to continue to execute, what they did not do is that fatal error, which we can talk about in politics in a second, is, it's someone's turn. And they said, it's so-and-so's turn, so we'll leave him in. They did the exact opposite. They ruthlessly said, if we're going to compete, we need these people, not those people, and they made a change, right? All they needed to do was call a vote and have a discussion and, sit down with the partner in question and have a discussion. I think that's healthy, right? I think some of these orgs where so-and-so can't be touched, you always say to yourself, does that create a false sense of security when you just can't afford to have that in this market?
To me, I think it's like a specialization in leadership that's kind of correlated to actually the winners and losers in venture in the next 10 years. And I think the winners are Walmart, which is your mega platforms. It's your Thrive, it's your Lightspeed, it's your GC, it's your Walls of Money, and it's your boutiques, which is your Chanel's. Walmart versus Chanel. And the boutiques are your benchmarks, your USVs, your specific products. And I think when you see this splintering of leadership between Alfred Lin and Early and Pat Grady on growth, I wonder if it's this kind of attempt to play into one of those, because right now I do see them, and I love Sequoia and I respect them intensely, but actually in the middle, which I think is quite a hard place to be.
They are more like a manager of managers. You have an early stage team and a late stage team. What that means, by the way, and I want to talk about this for a second and then come back to the megafund comment. What that means is the person on top is no longer even a manager of venture firm. He's a manager of managers of venture firms. One of the big ahas is being on top of those organizations where you have these structures underneath. It's just a very hard and precarious place, right? If you're not actually running one of the groups that's putting out the money, if you've allowed your job to become helping other people do things who in turn are managing money, you're more removed from being able to eat what you kill, and it just becomes a more precarious position.
Having watched venture firms and law firms and others, I really can't think of something more dysfunctional in many ways than partnerships. One of the reasons partnerships are dysfunctional, and maybe it does tie this, then maybe we could move on, is that it's almost impossible for performance to tie to economics, right? If Harry and I are equal partners, if the three of us are equal partners, and I have all the winners, it's all fun the first year, but the second year I've got the winners, and then Harry made that big bet, and it blew up on us, and we're friends, but our carry is equal, and then we're raising another fund, and we have to argue over a carry in the next fund. My limited experiences in partnerships, the daggers are always out. And I love your kumbaya view, Rory, but I haven't seen it in the real world yet.
I'm going to push back hard on that and say, I didn't say the daggers weren't out. I think, again, respectful professional people. Because seriously, let's talk about this. In the end, economic performance drives change. One of the things about Sequoia you got to admire is they didn't do we've made this decision, let's stick with it for 5 or 6 years. They did it's not working, let's make a change. It's very Sequoia. It's very on brand.
Listen, I want to discuss Michael Burry, famed for Big Short, pulls another big short. A big short from Michael Burry this time, $1.1 billion short on NVIDIA and Palantir. Had some pretty significant ramifications on market. How did we think about Michael Burry and the subsequent downfall that it caused?
Zooming out, I think you look at the AI CapEx spend and you go, at some point this is going to overshoot, and then there's going to be a downturn. Big, uncontroversial statement. Even Sam Altman would say it, right? Because I did the numbers because it's not my normal, but I decided in this case I've been opining on AI CapEx, and I said to myself, what would it look like to make Michael Burry's bet? And let's make it real here, right? Actually look at the numbers. NVIDIA stock on Monday was $188. If you wanted to buy puts at 180, which means these things have no value unless your stock is below 180, right? You can bet, and let's just say you buy December of this year. So you got 47 days for that stock to go down, right? For every $9 you bet, right, you make 2x your money if the stock goes to 160. So you got to call it's at 188 now. You got to get and you make 8x your money if the stock goes all the way down to 100. In other words, almost halves, right? So you only got if you're buying puts, you betting that in the next 47 days, you got to have that stock go from 188 to 160 just to make a 2x on your money. And remember, if it doesn't go down, you lose it all.
You don't even get a quarter.
Yeah, you lose it all. It's not like a stock. So I look at that and I'm going, I've got to get it right to make it 2x, and that's pre-tax, right? I'm saying, would I have the guts to do this? I believe the CapEx is overinvested. I believe at some point it'll correct. Would I take that bet? Would I put $1 million in where I could get $2 million if NVIDIA goes from 188 to 160 by December 20th or whatever it is, and I lose it all if it stays above 180? No, right? One of the interesting things he did was he released his filing early. In other words, he didn't have to disclose it until the last day. I think it's 45 days after the end of the quarter. He disclosed it early. And to me, that was probably him trying, because if you're taking a very tightly coupled time bet, where you've only got 47 days to be proven right, you want to this is where COP is right. You have every incentive to pile out the bad news and shit talk the stock to try and move it down, right? So that's, so you're not just a passive investor. You're actively trying to say, hey, everybody, look, this is a pile of shit. It's going to go down. And that's what he was doing in a very polite way by giving people the information earlier than he legally had to. And as someone pointed out, he's filed on the last day every other time. And this time he filed early. So this was someone saying, hey, everyone, look, this is my bet, right? So that's what it takes. And I just did the other math. Interesting math is if instead you decided, no, I don't think it's going to crash in 47 days, right? But I think it's going to crash over the next 2 years. So I'm going to buy these long-dated options, leaps. So I'm going to buy puts. Same thing. I'm going to buy puts. Stocks at 188. I want to buy puts at 180, right? And they're going to cost a lot more. They're going to cost like $50-$55 per trade, right? And now you lose money unless the stock in 2 years gets to below 150. And to get a 2x, to get that same 2x, it has to go below 100. Right. So it brings home how, people talk about shorting, and obviously shorting is more risky than buying puts, but it just brings home how hard a business it is to bet against AI capex. That was my big takeaway.
I don't understand as an asset allocator how you can rationalize that as an economic decision to make. Like, just against other asset classes, what you have to believe for that 2x to be real, risk adjusted, it's not a good decision to make.
Yes, it's a very hard decision to make. There will be one moment where if you get the timing just right and you see, remember, we did see a 80% NASDAQ decline in 2000. If you time it right, you look like a genius, but it's so hard. I agree with you. On average, the return, especially to amateurs like me trying to do options, it's just net negative because it's a zero-sum business. Unlike equity investing, where there's an intrinsic overall return, for every winner in options, there's a loser. For every idiot like Rory, there's a smart guy the other side of the table who prices it better. So I agree. I struggle to think how most people can make money shorting, which is why, to your point, Harry, in some weird kind of way, it's kind of good that there's some guys like that out there. Was it Jason? You made the point. Just keeping the whole system honest. That's an expensive way to be a policeman. You got to bet your own money to police the system.
That's bold. It's courage.
If you're great at it, what Rory's point is, it's almost impossible to be great at this. If you are, you get leverage. You do get leverage on your investment. So it's a great way to get leverage, but man, you better be really good at it, right?
You got to be right. Jason, the thing that really impressed me when I did this analysis is you not just got to be right, but you got to be right on timing. I think it's easy to be roughly right. I'm going to say it here. I think Michael Burry is right. It's very hard to imagine a company trading north of 110, 120 times revenues like Palantir, growing at 50 or 60% last quarter. Great, amazing quarter, kicking off cash. It's very hard not to imagine in the next 2 years that doesn't have a significant correction. It's very hard to imagine that the AI capex boom doesn't have a significant correction. But going from that kind of arm-wavy bullshit podcast statement to actually being able to make money on it, that's damn hard.
You said about kind of, the excitement waning from AI and air being let out of that kind of bubble and excitement. That's all predicated around, will the revenue show up? Will the revenue show up? Well, the revenue is showing up. Altman says OpenAI is going to hit 20 billion ARR this year. Anthropic projects 70 billion in ARR by 2028. The revenue's showing up in the billions.
Agreed.
Are we not answering our own question? And do you think we're almost being overly negative in asking where's it showing up when it's already showing?
Agreed. And you are, and they're upticking their estimates, not just a few. I regard, if you're changing your 2027 estimate up, I don't care. But the real fact is, if you're changing your 2025 estimate up as the year goes on, that's an enormously positive signal. And I think Anthropic in particular has been doing that. So you're right. The revenue is showing up. The growth rates are showing up. And even when you look at, Core, we've had a little bump today. But their problem is not lack of demand. Their problem was, oh my God, we couldn't get the data center up and running. So right now, it's very hard to make an intellectual case right now for anything other than there is massive demand for compute and there is massive revenue traction. So what you're left with is saying some version of, I don't think it'll grow quite as quickly as other people think. It's all in the hypothetical. Right here, right now, the revenue has shown up. And
we look at Gamma announced last night. I was reading at midnight after my AGM, Gamma raising $100 million at a $2.1 billion valuation, having hit $100 million in revenue with 50 people, 2 million ahead.
Yeah, we run
efficient.
SaaS on Gamma. It's great. Every day we use it. It rocks.
And so I guess I'm just asking, are we being overly British? Are we looking for a problem that's not there?
First of all, I'm definitely not being over British, and that if that's what's happening, it's time to end this show now. Sorry, Harry, but I think you're right. Actually, there's wisdom in what you're saying. I mean, look, I've seen it. Loads of people have quoted it, but cynics sound smart and optimists get rich. This is a great, enormous mega trend. It's the biggest mega trend maybe since the early days of the internet. Maybe it's even bigger. It's an enormous, ginormous mega trend, and leaning into it is the only sensible thing to do. And playing against it is dumb as rocks. The only reason you even have discussions, you have to have the second order comments. To make your question useful, because on an overall trend basis, you're of course right, the demand is huge. It's some version of the question, are we going to sign 80 billion of CapEx for next year or 40 billion? Now, both of them are still huge. Both of them are still, the trend is exploding. Both of them are still, everything's amazing, but one of them is 40 billion more than the other. And that's where you do have to start saying, things are enormously great, but are we over extrapolating? So I don't think it's being negative to simply say in a hyper-growth company exactly how much should you lean in, how much risk should you take. That's all that's going on here.
Let's talk about Gamma. And I actually did an all-company meeting for Replit last night. I mean, they want to end the year 250. I can tell you what I learned from both. But we use Gamma at SaaStr. Folks may not have heard of Gamma. Folks talk about it as like an AI PowerPoint, but they miss the point. I'll tell you how we use it. So we use it now instead of when we have to close 8 million of sponsors at SaaStr a year to keep the lights on. Instead of sending them the same dated prospectus, which we did before Gamma, the same crappy thing, now Gamma automatically pulls all of our data from Salesforce and our marketing automation system. If they've been before, it knows the exact number of leads and ROI from the calculation. It knows who their competitors and similar companies are, and makes a fully dynamic piece of collateral for them in about 10 minutes. Okay. And we spend, now it's actually a great deal. We spend $100 a month for Gamma. Okay. Now, a couple ways to think about that. One, it ain't much for what I just described, is it? But it's $1,200 a year. How much do we spend for Google Slides? $0. It's built in. How much do we spend on PowerPoint? I don't even know where my key is to Microsoft Office. So it is a stealth TAM expansion that we're spending $1,200 a year on PowerPoint, but we are, because the AI is Gamma. I'm the biggest super fan. It's all over SaaStr because you can do epic things that we would have to wait for a marketing ops team 3 weeks to never do and do a crappy job of. Now we do it in 10 minutes. And so we are I see why if they keep going, it's $1 billion ARR business. 20x revenue doesn't sound expensive compared to some of the deals we've done, does it? It doesn't sound expensive. It's 1 to 100 in 11 months at 20x revenue. Sounds cheap
and profitable.
Yeah. Now, look, there's some meta issues. I think we're going to see a lot of these folks, adding revenue teams, adding sales teams, adding marketers, never at the ratio of 2021. We'll never see those levels of staffing of humans, but more power to Gamma getting to $1 billion with no sales team. And Canva got pretty far, right? But knowing a few folks on the team, the B2B use case is pretty small today when I'm describing. As that blows up, they're going to add a whole GTM team, right? So it ain't going to be, they're going to need 100 people to service it. But yeah, I think we are underestimated. And for what it's worth, the other thing I did this so I've been vibe coding for 126 days. Feels like a lot of change. So I did this presentation, all hands at Replit, 125 days and 10 apps. I launched 10 apps in 125 days without an engineer. And I shared the data and most of the stuff that went well and a few areas to improvement. And I learned a lot of things, including the engineering team there is really, really, really good. But it occurred to me in the middle of this while I was talking that the agent now, the Replit agent, of all the agents we use about 20 agents, 12 real ones. The Replit one, the V3 one, is the first one that is literally part of our team. Not making us more efficient like our SDRs and BDRs. Repli is part of our team. It now has essentially infinite context window. It remembers everything I've done for the last month with it. It remembers all of it. We talk about it. We talk about our mistakes. So I'm doing the presentation. I'm like, I have this new idea. I want to build a page that spotlights all the AI apps we've spotlighted on SaaStr. I want to rank them. And I want to do links and everything so you can go discover these, all the ones we talk about. So I fired up Reply. I'm like, here's my idea. And he remembers, yeah, that's what we did on the other one. That's how we're going to do it this one. In 15 minutes, we're in production. Like Copilot, the lame thing about Copilots is they were just tools. I mean, tools are great. When the AI is part of your team, for real, not VC talk, the amount of revenue that it's accessible is so high. If you go to our office, we have little signs we make fun of them. We have Reply for Replit. We have Arty for Artisan, which is an SDR. We have Quali for Qualified. You can see how clever we are in our nicknames, right? Arty, Reply, Quali. And they all have these little desks where there's no human at it anymore. It's kind of weird. But Replit V3, this latest agent, is the first one that jumped the line to not being one of the parts of our team, but literally being part of our team, just like a human being. And so that is just going to unlock so much revenue. So much revenue. That's just starting to be capable now, right? When Gamma is part of your marketing team rather than a marketing tool, I mean, there's a lot of revenue expansion if they can pull it off. A lot of revenue expansion, right? So I think we've just got, I know this is VC tritism, but I realize being deep in the trenches, we literally have just gotten going because these agents are so much better than 90 days ago. If you're not doing it, it's hard to see how much better it is. I think people miss, they're not doing it. And so they're missing when we cross the line when AI is part of your team. That's what's coming in 2026. We're missing this. The agent was the story of 2020. The Copilot was the 2024 story. It didn't work. It was a ripoff. Spend $30 more a month on Office.
Didn't work.
No one wanted the ripoff. This year, OpenAI and Claude finally actually got good. That's why Lovable, Replit, Gamma exploded. Gamma was founded in 2020. It had no revenue before this year. Replit was founded like in the 1800s. It had no revenue until this year. Vercel had no revenue until this year, right? And they exploded. That was this year, was the AI works, right? Next year is AI as part of your team, not replacing folks or layoffs. It is literally embedded in your team. And I talked about it, but now I see it. And that's where we should be investing. That's where we should be investing as VCs, as humans, as leaders, is what happens when AI is good enough to be part of my team. Part of my team.
And you distinguish that. I want to go down because I'm actually here to learn too. Is that you distinguish that from just having an individual agent? What's the difference between this Replit as an agent or what Arty as an agent versus being part of your team? How do you?
It is sufficiently autonomous, knowledgeable, and powerful to complete material, high value tasks on its own with some daily discussions, just like on our team. You got to check in. Like some folks, we can check in just once a month. Like that's enough, right?
Okay.
But it does need some oversight and some discussion like a human does. But the level of autonomy and capability, Gamma, go out. We've got 20 sales calls this week, Gamma. Go into my Google Calendar, create prospectuses and sales collateral for all of them, pull all the data on them last year from Salesforce and HubSpot and Marketo, put them all apart, review them once, and then distribute them to the team. And if you can, join the meeting, right? When Gamma can do that, Gamma's part of our team. It's not that far away. It's not that far away. Not just make me PowerPoint, not just, Gamma's the AI, the PowerPoint for AI. That's not so interesting. But Microsoft will figure that out. Canva actually has a Gamma clone now that's not bad. I mean, a lot's changed. AI is so fast. When Cliff was on the show, like I accidentally was a little triggering on Gamma. I didn't even really think of them as competitors, but that was the only time Cliff got a little thoughtful. I mean, he was always thoughtful, but now like that wasn't even that long ago, was it? Now like their version of Gamma is pretty good.
Yes, which is why Gamma's got to keep swimming and add all that other functionality, which they are.
That also goes back to the beginning of the Sequoia. So that's why investing is so stressful today.
I think that's
so
the real answer.
stressful today.
I'm glad you said that, Jason, because I'm sitting on, we were talking last weekend in a partnership about technically what you really need to understand is what the improvements in the last 12 months, I think it's what you're saying, and the changes in the model in the next 12 months means in terms of what can be done that wasn't doable even 12 months ago. And that requires a quantum of time to just get your head around it, right? And it is so stressful because just finding that time, you got to make the priority to find that time to know where it's going because the pace of evolution is so fast. If you decide, well, what I knew 6 months ago is still useful, you're probably going to be wrong very quickly, right? That's what I find the most stressful about right now, right? Is making sure you actually know where the technology is right now versus your opinion 12 months ago. You're right. You look back and what things people said 12, 24 months ago, and they're laughably wrong, right? Like the whole Copilot thing. I mean, that was like, thank you for sharing, but no. right? And that's just so done. And just trying to have clarity on the next 12 months just to be able to play. And because without it, you're betting blind and you're going to get it wrong.
There's that. What I think is even more stressful for seed, maybe by B, it's a positive. Maybe Andreessen investing at Gamma at 100 was the smartest play of all. Or at Replit, right? At later stage, well, they did early too, but is like, I think the quality of clones is only going up. The ability, when we all started in this industry, you'd laugh. You'd be like, well, Salesforce, or forget a HubSpot, pick whoever you want, whatever leader. Yeah, it'll take them like a year and a half to decide if it's worth cloning. Then they'll launch something and like, it'll be okay because they have smart engineers, but it won't actually do anything the first 6 months. It'll be so feature poor that after 2 years, they'll decide, well, should I put 100 people on this or should I put 100 people on so you had like 3 years until the big guys would really compete with you. I'm not kidding. I can think of one investment I've made that has had 5 clones, like in the first 30 days, including one from a cloud leader. And we can now the same thing will be true. Will they sustain it? Will it just be a feature? But the ability of AI to enable us to clone better stuff faster, the fact that Canva is borderline competitive with Gamma and wasn't when Cliff was on the show, it just disrupts what the hell does seed investing mean? What the hell does seed investing mean when anything, even with progress, you might see 10 better versions in 30 days?
What does that mean you do then? Like, I'm a student of this business.
Yeah. What do you do?
For seed? I think, I don't know. We should ask the new benchmark guy who's smarter than me. But for me, I think the answer is the old one. I'm worried it won't hold, which is the innovation plus the best founders get there. You've got to still bet on the best founders. You just can't take that early first month explosion as seriously as you used to. It's not as defensible, that innovation. But if you have the best founders, what else are you going to bet on?
The interesting question is, to your point on doing Gamma at 2 billion, do you think that same statement is true? So fast forward, you're now Gamma, you're doing 100 million in ARR. Do you think the next clone who starts at 0 can catch up? Or do you think over time that the distribution moat, the market brand leader moat, do you think some kind of moats accrue over time with scale, or do you think everything's up for grabs all the time?
No, I just think what I think is there is a plane of stability that is later than it used to be, that is still fragile. I'll give you an example. So at Replit, whatever, I don't have the exact numbers. Let's say they go 1 to 250 this year. It's going to be less than Lovable, Harry. We'll stipulate it's not as good as Lovable, okay? But here's the thing, what has happened in Replit, is most of the competition can't build the AI agent they can. So even Bolt, which was the early leader, they're now just at number 3. They don't even have an AI agent anymore. They've outsourced it to Claude. And so these products that are really, really good are building a deep layer of sophistication. But if you don't get there fast enough, and we can argue whether Gamma is there or not, if it's sophisticated enough, and if anybody on this hasn't used Gamma, I tell everyone to use it. What you do is go into a Google Doc, write 10 points about this show, and then just give it to Gamma and say, make me an amazing deck, and your jaw will drop what it does when it's coding this deck in real time. Just give it 10 bullet points. It does so much, but you sure better be working that 996, right? Because Cliff's got a few good folks. It used to take Cliff 3 years. Now it takes Cliff 90 days. I don't have the answers, but that's why I think 100 million, 250 million, these Gammas start to build a moat. I do believe Replit has a moat, maybe not versus Lovable, but versus all the rest. But man, you used to get a moat earlier, didn't you?
But that's where I think vertical specialization does accrue benefits with scale. An example is, I did a deal in Solve Intelligence's AI for patent law. The more patents that go through their algorithms, the better they are at writing, editing, predicting. And it's a very specific use case that gets better with more and more data ingested. You don't get that with horizontal products.
No, and data is going to be defensible in the age of AI. Data is going to be defensible, but those patents are public, right? They can still be ingested by other people, can't they?
Yeah. And just for the record, I don't know if it's, yes, they can. I don't know if it's true that you don't get it with horizontal. And I think you probably do. I mean, I think that, would you take Cursor as a horizontal product? Would you fund another company now from scratch to do exactly the same thing? I think not. I think there does come a point when you do pull away. I don't think it will remain unstable forever, right? In the sense of, I don't think you'll have these $200, $300 million companies and then someone else doing roughly the same thing come and displace them. I think there's this uncertainty period at the start, but I could be wrong. processing in real time here.
Well, I think that Harry's point about the patent one, let's step away for a minute.
Yeah.
That I think is interesting is, the classic question in B2B, maybe all venture, but certainly B2B venture since we all started is, how important is it for something to be defensible in the early days, right? And we've debated this for years, right? Since the inception. And we've all known deep down, no product that can be built in 60 days can be all that defensible. But we told ourselves the team had domain expertise or this or that. The question is today, has the bar gone up? Should we either give up on defensibility for seed investing, just give up that is a criterion, or should we radically raise the bar, forcing us to go into verticals, corners of the market, areas where there aren't 11 agents, already 100 agents? Harry tweeted about support the other day. I can tell you when I invested in support in the early days, Talkdesk, gorgeous, front. No one wanted to do support in the early days. Everyone thought this was the dumbest category. So go find, now it's trendy. Don't do that, right? Maybe go find something the cool kids aren't in.
I think it's simple. I don't think you can have a major defensibility team in any of these horizontal or verticals at the seed or even, frankly, the stage we're investing at, right? The defensibility theorem emerges at scale, right? In other words, I do believe what's true in most enterprise businesses, once you become the anointed winner, once a market coalesces and there's 2 or 3 people, at that point in time, it's yours to lose. You can still screw it up, but provided you have great engineering and stay on top of the trends and top of the technology, you should be okay. I think the idea that at the seed stage, you're going to find a defensible way to do code gen or code testing or is absurd, right? And you just have to internalize the game you're in, which is you're going to have to, for most of these deals, unlike deep tech, you're just going to have to awesome team, run fast, be superlative on technology, get your distribution early, and then rely on that. And then as you scale up, then you become the winner. You can't be anointed the winner up front. Get over it, everybody. It's a high risk game.
But right? Is that okay at 50 post for a seed round or a pre-seed round? Do the outcomes justify it? That's the thing. Sure, Rory, if the deal's at 3 post or 5 post and I can spread my 500K checks around, I get it. If I have got to spread $5 million checks around at 50 post, it's tougher.
That's a much better question, because now we're gone from the abstract of is defensible to the actual nuts and bolts of money, right? We've recognized the game we're playing has more variance, we think, than the last time and has to run fast. And there's probably also more competitors. Are you getting paid for the risk? Yeah, I wrestle with the same thing a round later at 100 or 200 million pre, right? Am I getting paid? And we have this constant dialogue. If I look at, we do A's and B's and, the early product market fit A, you probably still don't know who the winner is. And the B, when you know who the winner is, it's going to cost you a fortune. And which of those is the better bet, right? We don't do pre.
But do you think at the B you even do know the winner? We look at the B, you mentioned my customer support tweet. Most of those companies had rated Bs. I got no idea who the winner is in that category, and I don't think anyone does.
I think you can have...
We don't know.
No, I'm going to push on that. I think you can have, somewhere between the A and B, you can have a much better hypothesis. Put it this way, you can know a lot more than you know at the seed or the early A.
Do you, when the Bs are preemptive on 3 to 4 million of ARR, which they are for hot companies today, do you?
It's interesting because this is absolutely what we have to know to do our business, right? Because at seed, Jason can't know. He can just believe, right? But somewhere between the A and the C, you have to know. Otherwise, we're all ludicrously overpaying. And I think if you look at all these markets, like, for example, you mentioned your patent company, I think... without naming it, I think we have a rough sense of where all the companies are. I think your company's doing very well, Harry. You should be glad to know. And that doesn't mean I know where the market's going to end up 10 years from now, but once the horses are running and once they round the first furlong, you can actually see the rank order of where they're running, right? In a way you can't at the early A, right? $2-3 million in revenue. You're drawing on small pieces of information, but you can see rate of change and differences emerge pretty quickly, right? So I disagree. I think you can have a pretty good idea. Look, it's hard, but
I mean, I genuinely, I don't want to be rude, but can you give me an example of where you think at the B you have had a clear understanding of a winner?
Take Cogen. There was a bunch of people there was 10 to 15 companies at the A or earlier. I think it emerged Cursor. I think it emerged, kind of Windsurf, and then difference extent cognition by the B, and it was obvious that those were the names.
I would push back on you there and say that I don't think we know at all. I think Codex is making incredible ground. I think Claude Code's making incredible ground. Curse is very good. But then, as you said, you've got cognition, you've got the Replets and Lovables kind of coming from the kind of prosumer, less developer-centric. I think that's still an entirely up for grabs.
I think also we didn't, if we look back, because we've talked about this earlier in the show, I think looking back and nothing but kudos to the team, right? But I think when Windsurf sold, whatever happened, it wasn't clear it had a sustainable mode of any sort. It wasn't clear it truly had. It was a darling of a slightly more enterprise version of Cursor. People did love it, but ultimately it wasn't clear it was a winner then. It wasn't clear that brand was enduring. Looking back on it, it wasn't. We don't know if it would have even survived as a standalone
company. I think that's
company.
True, but at the same time, what was clear is over the prior 6 months, it was that if anyone was going to be the perceived company worth acquiring, there was only 2 or 3 names in that space, and the other 7 or 8 names that had been around weren't. Right? So I understand what you're saying. It's not clear at that. The reason they took the deal, it wasn't clear they could go from where they were to, $1 billion in revenue in an IPO. But what my point is this, going back, we're dealing with probabilities here. At the seed, you know nothing but the people. At the early A, when there's 5 or 6 of these companies doing $1 million plus or minus in revenue, all you know is you got a 1 in 10 shot. Somewhere at the B, I think you get down to being able to say it's a 1 in 3 shot. It's still a 1 in 3 shot with a huge amount of variability, right? But the odds have narrowed. You guys keep talking about Lovable and Replit, right? You would say, implicit in what you're saying is, those are the 2 names. You implicitly said, I don't know the space as well. Bolt is not has shot its bolt, as it were, pun intended. So yeah, that's a piece of information you have. When you're making a bet at this stage, you can probably say something like, there's 2 clear winners here, probably less likely to be another raw startup. There is adjacent competition from, the Wix has bought someone. So you at least...
I'm so sorry to interrupt you again. I would just say you need to expand it significantly. It's not 1 in 3, because you've got Vercel and you've got Claude Code who are eating their lunch coming down. You've got, as we mentioned, Replit and Bolt, but then you've got, Salesforce who have their competitor. Atlassian have their competitor. Figma Make is doing very well. It's 1 in 10.
You're right. So the adjacent competitors, let's talk about because I always think there's a 2-step horse race in all these deals, right? And by the way, I'm going to argue what you just said is proof of success. Let me tell you what I mean by that. In any startup, you start off on day 1 and you're like, there's 3 other startups doing or maybe 10 other startups doing just what we're doing. I wonder which of us will win. And my experience is when you go to the first board meeting where you suddenly realize you're scared of the big company adjacent competition, it probably means you've graduated from the baby class. You're one of the 2 or 3 winners in the startup land. And now you got to worry about the adjacent guy next door. You might say you're not sure if your Lovable bet's going to be the winner yet, but do you believe within the class of venture bets on this space, you've got you're in one of the 1 or 2 winners?
Yes, but that doesn't generate enterprise. But that means shit. It doesn't matter if it's one of the venture bets. If one of the venture bets doesn't win and Salesforce or Atlassian or Canva does, I don't care.
Obviously, you're correct, but you got to think about it just like incremental information, updating your priors. When someone did the seed there, they were like, this is a good idea. It might not even work. Right? Then you do oh my God, vibe coding is a thing. There's 5 companies doing it. We're one of the 5. And now you can say vibe coding is a thing. We're one of the 5 doing it, and we're one of the 2 winners. Right? A huge amount of risk reduction. Now you still have the other risk, which is the big companies might do it. Something might disrupt you. There's a lot of risk still left because it turns out that startups are risky. But you've got to admit that there's been a massive amount of information gleaned, risk reduced from, going back to what Jason said, is the 5 on 50 bet where you don't even know if it's a space and you don't even know if you're going to be a viable player in that. Is that a better or worse risk than doing 2 billion pre when you know both those things? You are the winner. Yeah, there is a space. You are the winner, and there's still a whole ton of competition to come, which is the Lovable bet you made. Which of those 2 bets are riskier? I don't know.
I think about this, which is, at about, I'm again butchering, but 4 to 5 million in revenue. It was done at 200 when we first did it, and then when it was about 80 to 100 in revenue, it was done at 2 billion. You can choose your entry price.
Totally. That says to me is consensus, rightly or wrongly, has said there has been a massive risk reduction. And now, unfortunately, what's happened and always happens in the bull market is valuation has expanded to fill the risk that was reduced operationally. In other words, at 4 to 5 million, there's still a ton of risk, right? Fast forward when you're doing 50, 150 million, I'm just going to say it, you can't deny there's been a huge amount of operational risk reduced. Now, the problem is at 2 billion pre, are you getting paid for the, is there enough upside left in the deal? Separate question. But I think the point I'm making is it's gone from being is this a category? Are they the winner? It's gone to the third and last question, which is always, is the TAM big enough to support a $2 billion valuation? Which is much more a late stage question.
It absolutely is. I just want to go back to the, we kind of know the winner at the B. And if we don't, and if that has reduced or got less, are we overpaying? Was an interesting addition.
Yeah.
My statement is we dramatically know less, and that 1 in 3's moved to 1 in 7 to 10 significantly across categories, in which case, surely the suggestion is we are dramatically overpaying.
There's some level of truth in what you're saying. I think the variance in these companies is a lot more than the 15 boring years of SaaS is obvious and you know what to do for the next 10 or 15 years. Jason and I would both say, we both had a play, Jason as a leader and a founder, I just as a humble investor, in an e-signature company. When we did those deals in 08, 09, it was e-signature, and fast forward 10 years, it's still e-signature. That was a simple world. We would both agree, I think, that there's way more change in this market in a year than in some of those older markets in 5 years. So we'd agree that. So you are right, there's more risk, Harry. All these investments, I think, are riskier than they were in SaaS land, and they're astonishingly priced higher, right? I would agree on that. But I still think there is some significant risk reduction in going from a 1 in 5, 1 in 10, will it even work, to a 1 in 3. I know who the competitors are.
If that's the case, should our B portfolios be more diversified? Jason put as a great question, do seeds need to be diversified?
Well, how big a fund you do, right? Or if you're going to write, if seed checks are 5 million, how big a seed fund do you need just to make the minimum diversification work? How big does a seed fund work with $5 million seed check?
Well, it depends if you think outcome sizes are expanding with the movement from technology.
Does it matter? It's just some basic
math.
How many first checks do you want to make? Do you need to make in that fund for it to work? So if you traditionally needed 20 or 30 checks to work, but risk has gone up, to Harry's point, maybe you need 40. So, and what reserves you mean? You might need a $500 million seed fund to have sufficient reserves, because I need to do 40 deals at 5 million now. That's 200 million, 200 million for reserves. That's 400 million, 100 million for fees and times and backup. I need at least 500 million for my little seed fund to make the math work.
What you're missing on the maths is if you think that the outcomes are going to expand, you can have a smaller ownership on entry. And so you don't need to increase check size if you assume
4 million out of 50. Does it really matter? These are not massive owners. 4 million. Who cares? 1 million on 50 isn't going to work, Harry, in my seed fund, is it? It's not going to be enough ownership, is it?
I'm just trying to disaggregate Harry's response because there was something. It was interesting. First of all, I agree with Jason's framing. And then your response was interesting because you could have said one of two things. You could have said, you don't need to go from 20 deals to 40 because the winners are so much bigger that even if you have less winners, you're fine. That would have been one. But you didn't say that. Interestingly, you said implicitly, go to 40, but just take less ownership, right? That's what you said. So the mere fact that you made that answer, says you are embracing a more diversification story in the face of risk, which, is Math 101, which is a super interesting concept because we had it down on the agenda to talk about, and some folks are even pulling it off. These highly focused seed stage bets, which I find awe-inspiring because all other things being equal, with the amount of variability you're seeing, I would have expected people's deal count to have to creep up slightly. But, we had Roger on, who is very much a concentrated bettor. You have the hummingbird story in Europe, which is astonishing and impressive. So everything in logic says to me, with the increase in time to exit, and with the concomitant increase in risk, logically, you should be increasing your diversification slightly, probably reasonably, which probably means either smaller checks and more deals or a bigger fund size to maintain the same ownership.
Well, I think both work really in a lot of cases. I mean, I'm in one fund as an LP, and it has 150 positions with 100 to 150k checks. It's a 7x fund, and it goes to my point of the outcome sizes being so much bigger, and so the ability to have lower ownership. Jason, to your point, 1 million on 50 does work if it's $100 billion company, not the $3 to $5 billion enterprise outcomes that we've been playing with for the last 10 years.
Yeah, works even better if you own 10% of that company, though. You got to have, listen, it's your call. The thing, the 100 to 200 fund, I'm not that human. I don't want to meet 500 founders a year, right? To do 200 deals between your team, you got to meet 500, 600, 700 founders a year. Even with your AI agent helping you, I could barely tolerate doing a couple meetings a week. I can do stuff by email. But God, I got to carve out an hour for a deal I might not do. I want to blow my brains out after that meeting. I sold my company to not do those meetings anymore.
I mean, so I can tell you, our partnership does 20 meetings per partner per week. And so now with my 4 investing partners, we have 80 net new companies that we meet in person per week.
80 in person.
Yeah.
I would resign. I would give you all my carry back. Thank you for hiring me, Harry. I'm eternally part of the 20 VC team. You make me do 20 in person. Like, I sold my companies because I didn't want to spend my life in meetings. I'll do 1 a week. I'll do 2.
You do the math. We'll do over 3,500 company meetings a year. Yeah.
I think it's great, right? For the LPs and others. I think that is a great playbook. It's just not to get distracted. You got to match the strategy to who you are as an investor, where you get your leads, where you get your deals, what your brand is. You can do that, right? For a variety of reasons, but,
oh dude, I'd hate it. I don't do it.
Oh, okay. Okay. But the team does. Okay. And they bring it to you, right? Yeah. But it's a lot of meetings, man.
It's a lot of meetings. 100%.
It's a lot of meetings. Can I get you guys a coffee or a drink? You want sparkling or still? Which one would you like? Do you have DVI on the Mac? Here, sit here and wait. Harry's running late. Harry's doing the 20 VC of sports. He's running a little late. He'll be here soon.
No, I love taking meetings. That's how I learn. I'm a meeting junkie. My partners laugh at me. I'll take a meeting with anything, right? Because if you can always learn something from it. So I have a bias to meet. In fact, probably an over bias.
Do you think you can listen? I think when I meet a truly great founder, like truly great, I always learn a lot. Don't get me wrong. Anyone below that, I don't think I learn enough to be worth the time. I do my homework. Rory, you're the best homeworker of the team, right? You could do so much homework on an event. Harry's the most prepared and the most charismatic, but Rory's the best homeworker. Okay. You really if they're not great, you really learn anything in that meeting if you spend an hour researching the company? I learned nothing. I read your deck and then I said, send me more. Then I say, send me your last 5 investor updates, right? Send me your financials. And I'll research you on the internet. Now we have AI. Claude will help me. I'm going to know like a lot of stuff unless you're really great. Now, if you're great, you're going to blow my mind, right? But if you're not, I'm going to start yawning about 15 minutes into this meeting. Right?
I don't know. I find sometimes you get an insight. I think, and I could be wrong. You make, again, the beauty of doing this is you make me think, should I do things differently? Cause you do it so differently. As I do find, even on a okay deal, you learn nuances about a specific market from the one-on-one and the dialogue to and fro that you wouldn't get from the presentation. Now, it does mean I have as people who've pitched me know, a horrible interrupt-driven style whereby if you have 20 slides, I'll be like, we can skip 17 of them and these 3 I care about, which can be annoying at times. But I do think there are insights. I think in any business, no matter how much you think you know from the outside, the person inside living it every day has a crucial kernel of knowledge that you just can't access any other way. And I believe most meetings I get something from it. It's a little like your knowledge living AI agents versus anyone using those words is step function different.
It is.
And anyone
who's got
me
to learn that. If you meet all the other ones, it's a waste of your time.
Yeah. Agreed, but you have to meet them to get that experience. So I bias to meetings. We've come a long way from fund construction, but that's okay.
Yeah. Well, this is fantastic. This is what founders like. Again, the amount of founders that do not get to hear this, that actually wonder how VCs think, is in the hundreds of thousands. Yeah. And that is what's
what's related to it. It is. The question a lot of founders have is, how important is it to just get in the room? Just get my foot into the door. Just get the coffee meeting. And I think it varies. I think Rory's saying, listen, get in the room at scale. There's some value to that. I'm saying I have no interest. Don't get in the door with me. Just send me a great deck and a great email. I will read it. I will slow down. I will spend time. And if it looks good, I'll take the meeting, but there's no need to get in the door with me. There's no value in getting to know me. Coffee meeting. They're like, well, just take the meeting, Jason. I'm like, dude, I have so much respect for you, but there's 0% chance I'm going to invest. Don't try to get the meeting. It's not going to help you. Don't waste your time.
I don't think someone who's doing something I totally not going to do. Yes, but I do. And I'm not a huge fan of coffee meetings. I'm like, you're here to get money. I'm here to give money. Can we just talk about the business rather than, a bunch of getting to know you? But I am always interested in hearing people talk about their business.
That's why you're enduring in the business. That's why you're enduring, because you enjoy the meetings.
Yes.
Rory, how do you feel when you hear people say, no, I'm not going to meet. I'm waiting to run a process. And I'll run a process on the 19th of November. And I'll email you then. Because for me, I found this really abrasive. I'm just opening up here. I said to the founder, listen, if you're running a process, you're either optimizing for price or partner selection. I'm giving you a great price today, a price that you said you wanted, which means that you're not optimizing for price with this process because I've given you what you said you want, which is just saying that you think you can get better than me, which may be the case, in which case, just tell me straight you think you want Sequoia or Benchmark, in which case, no harm, no foul, but fine. And they're like, no, I just want to run the process. How do you react to, I want to run the process?
I think from their side, they're correct. I don't have to like it, but I think from their side, I think I see more failed financings because they didn't run a process than they did. You're basically saying, Mr. Founder, you don't have to run a process because I'm going to give you a term sheet right now that's a good price and you like me. Let's do it, right? That's not an unreasonable offer, but typically what happens when people, quote, don't run a process is someone comes in and says, I'm really interested, and they share and they give information serially to someone who's not yet ready to commit on an investor side. So they've run an accidental process, right? That's a mistake. Do you understand me? So when I see, because I would quote
my founder, here's your term sheet. There's nothing to be done.
That's different. I mean, at that point, it's not crazy. If that happened, if I was on the board of a company that had that happen, I would take it seriously and I would think, should I hit the bid? Conversely, if I was on the board of a company where the founder said, hey, I'm meeting with Joe at Mega Firm. They asked, can we share some data? They're not, they just want to get a sense of it. I would shut that down and I would say, you share with everyone or you share with no one, because giving your data to one or two people where they're not in is just starting a process without meaning to start a process. And then if they don't move forward, you've kind of had a failed process already without ever doing a process. I'm 100% certain that that's a mistake, right? Mm-hmm. Even though on my side of the table, I don't love that, right? But you're raising something, which is why a lot of times you wrestle as this is my aha, you wrestle as investors with, I want to be able to do what Harry just said. I want to be able to come in and commit, because it's the only way to get them off their process, right? And that means I have to, they have to have a good enough relationship with them. They want to do business with you. And on top of that, you have to bid with probably sparse information. And my big aha on that is the only way you can conceivably do that, no amount of pre-work can do it, because you don't know the actual information. If you've seen the prior round, is probably your best chance. Because if you've seen the prior round, you have some sense of what's going on. You know what they underwrote. You had a mental model at the last round. You can probably in a dialogue get one or two pieces of information, calibrate how they're doing, and maybe do that process.
I have a slightly nuanced view in the middle for what it's worth, just for maybe for advice to folks that watch, not to Harry. But when that happens, that Harry said, I think it's a slight founder fail, a slight own goal. Okay, not a total one, because obviously he's got a good company, right? Harry is in essence ready to do the deal now. The founder says, I want to run the process. I think what many of the best founders do, not all, there's all different types of founders, extroverts, introverts, great fundraisers. But what many of the best do is they're able to cultivate enough interest with enough good VCs that if they hit the number, they just send an email. They just send an email and they don't have to play games. Harry, I'm thinking about raising around before the end of the year. And Harry can say, I'll give you a term sheet today. And the right answer is, I love you, Harry. Especially love the one with Rory, but I'm not ready today. I'm not ready today. I will be ready at the end of the year. That is the perfect way to handle this situation. You don't risk losing Harry's term sheet. You don't risk accidentally. Few founders do overplay their hand, not as often as you might think, but they do overplay their hand. VCs, they can say the wrong things. And so the best founders, one way or another, build relationships over months. They copy them on their investor updates. They update it. And then 3 or 4 folks are just in when you're ready. They're just in. It's so casual with so many founders. They're just in. As long as the deal is reasonably fair, just tell me where to write the check and how much I can buy. And you don't break any glass. And I think the reason this happens, the Harry scenario, is so many seed investors and so many accelerators hammer into founders you have to run a process. That is the classic top 3 bits of advice. But I think it misses some nuance on the optimal way to run it. The optimal way to run it is for everyone already to want to invest for real without games before you open your data room. And the super optimal way doesn't even require a data room because you don't even need a data room because they already want to invest. They need diligence, but the best run process, I know this might be slightly controversial out of context, but the best run processes don't require a data room, not a traditional one. Not a traditional one, only one for diligence. They only require a file that says box-diligence investment 12, 21, 25. They don't need any other data room. It's just for diligence.
I think what you're actually saying is the best run processes don't feel like a process, but they are. And I think you're exactly right, is that if a founder is smartly nurturing relationships, keeping people broadly informed, but then tries to time the interest such that when he's ready to put his or her hand up, there's 3 people who are primed and ready to go. That is the best outcome, as I say. So it is a process, but it doesn't feel like one. And that is perfection itself. I agree with you. Now, you have to have a very attractive and high-performing company to be able to do that.
Maybe, but I also think those are the only ones getting funded in this environment. We talk about all the gammas and the schmammas, but everyone below that ain't getting funded anyway, so you might as well run this version of the process.
Because
maybe Harry thinks a lot of B folks are getting funded today, but I ain't seeing it. It's the most binary fundraising environment in our lifetimes, isn't it?
Expand on that, Jason.
You're either YC Neo, South Park Commons, got something, get funded, or who the hell's going to find you in your pre-seed round, right? You better be whatever the hell AI native is. I mean, we know what it means. You better be hot AI native with top quartile venture growth or you ain't getting funded. It's pretty simple, right? It's just there's not a lot of gray zone anymore.
But I do think even with that, you say YC Neo, fine, but they have a huge amount of companies per batch in YC. If you want to stick to the religious, we're going to run a process, that does work. Only if you have fucking stellar numbers. Because if you haven't relationship,
but don't do the hair. But I'm assuming
because if you haven't built relationships before and you start on Monday the 19th, to expect that you're going to come in, hit the ground running with first meetings on Monday the 19th, and get term sheets super freaking fast with average to net no numbers.
No, of course, of course.
I
was making an assumption in the story you told me, the anecdote of the term sheet, that it had top decile venture numbers. The very fact that they were flippant assumed it. Now, if they didn't, then they're reading too many tweets.
Zero to $1 million ARR in 7 months.
Yeah, I would take that offer. I would sign the term sheet and send it right back, and ask if you wanted to meet at Selfridges over on the holidays to see the Disney exhibit or something like we're doing with our team trip. I would say thank you, Harry.
Guys, because I think you were saying the same thing, because Jason's throwaway comment, but it's worth pausing on. He was basically saying you should run this kind of, let's call it this light process, which is very kind of FOMO driven, right? His comment, and I had said, hey, you can only do that if you're a good company. And then his comment was, only the amazing ones are getting funded. So implicitly what he's saying is, if there's 100 companies and only 20 of them have these kind of numbers, they should run that kind of process, and the other 80 are screwed no matter what. So he's not even invest. So 100% of successful deals will be this kind of FOMO-driven, non-process process. That was the implicit statement of what you're saying, Jason, right?
I mean, Harry's right. There's some non-truth to it, but I think there's a lot of truth to it. That we're in the Captain Obvious era of investing. Yes, and it only takes one term sheet, and spend your time going to Harry's point. And don't be careful. But man, I'm just Harry sees the most of any of us, but I'm just not seeing the non-obvious ones get funded. I just don't see it. I'm just not seeing it. I'm not seeing it anywhere, right? And the most brutal one is, again, the classic SaaS company, triple, double, which has been discussed ad nauseum on every 20 VC channel, right? Including 20 VC Cricket and 20 VC Sales. Those ones you could always find someone to fund if you met enough people back in the day. Now you can do better than that. And no one wants to, only 20% of people want to take a meeting, and they still might not do it. And I think every month that goes by, those deals are harder to do. Every podcast, everything makes them harder. Terry's disagreeing with me?
No, I'm 100% with you. We have and I like tangible examples because people can actually take it away. We had a company that went from 400K to 3 million in ARR, classic enterprise SaaS business, bread and butter enterprise SaaS that would have had 5 term sheets from 5 good firms, 120 meetings, 1 term sheet. And it was 10 million round on a 40 post. So it was, 12x revenue for a 10x grower.
But have you seen the market comps, Harry? Have you seen what the average public company's trading for? That's still a fine valuation.
Yeah, but they're not growing 10x, as Harry's point. But the real truth implicitly in that is I think I've said this before, it's a combination of some element of it's just not fashionable. But also the implicit statement is that growth rate's going to attenuate because, I might have, 2 or 3 years further on, that same investment, we might have a company doing 25 million in revenues. We invested was doing 5, but its growth rate's now down to 60%. It's still only burning $10 million, but those are incredibly hard deals to get funded. Right? There is economic value there, but they're hard to fund.
We're going to switch tack slightly, but I want to discuss 2 kind of crazy stories or results in the last few days. One good, one bad. Datadog absolutely freaking crushed. Stock up 23%, $15 million plus AI native customers. Wow. How did we think about Datadog?
I think Jason has covered this so well last time. His basic comment was, even if you're not AI first, co-attach to the AI trend and you'll be fine. These guys co-attach to the AI trend and they're fine. Sell shit to the people who are making AI, and if they grow, you'll sell more shit too. And they did it.
Love that as a summary. Jason?
No, it's true. The irony as we go into next year, the AI leaders, the hyperscalers and the hyper this and the hyper that, they're starting to buy like classic B2B companies. It's the same. And in fact, they're recycling the same people in procurement and the same people in GDM, and they're buying the same stuff. So this is, if you have attached to AI budget and you're a Datadog era and you're in that, you're actually going to have a great 2026 because these are normal B2B companies. Like OpenAI is buying like an Adobe or a Microsoft now. But if you're not in that, man, you're just dead, right? And the other one was Clio, which raised at $5 billion in legal tech. It attached to AI in a different way. This is a company founded in 2008 that found its way in the AI era, right? It added fintech payments, got up to $3 billion, now at $5 billion. So find your way, right? Datadog, it helps that Datadog, even though it got expensive, it was the darling, right? It was the darling product. But man, they captured that revenue. Yeah. Go find it.
It did because, I'm going to leave Clio out because I think it's so different. I think Datadog is a core piece of compute infrastructure. And these hyperscalers are the most compute intensive companies that have ever been known. So if you're selling compute stuff, you should be having, as Jason said, a great quarter. If you're selling routers, if you're selling switches, if you're selling little interconnects, whatever it is that's associated with whatever it takes to stand up Stargate. And observability is a key part of that, right? You're going to be golden because there's more compute than you've ever seen, which I think is a very different dynamic than some of the others.
Fair enough. If you're not attaching to that compute, something's off, right? If you're compute adjacent, you better be growing quickly. If you're compute adjacent,
yes.
Broadcom's crushing it. Why aren't you?
I'm a Duo shareholder. That was a shit week. Down 25%. Rory, the age-old thing, which I just love that you describe me with, is that's great, but what about me?
Yes, Howie, that's you.
Duo plunges 25%. I'm going, why? What the fuck happened to make it plunge 25%?
I don't think there's a mega story here. I think that, Duo has been, I think they've just been, they've had they're still 80% up on their IPO 4 or 5 years ago. They had a period when it was, oh my God, AI is going to kill them. Then the CEO very wisely got ahead of that and said, we're using AI. So then the stock got way ahead of itself. And now it's like, AI is not going to kill you. Now is it going to make you enormously rich? You just guide it down for next quarter slightly for business fundamental reasons, and the stock was overvalued and went down. I don't think there's a big story here. It's like, it's still, the graph it's still, as I say, up in the 5 years. It's still significantly up on its lows. It just got ahead of itself. They had a good quarter. The revenue guidance was slightly less. Life goes on.
Oh, I'd say it has the wrong kind of AI. And what I mean is Duolingo is using AI to make its product better, right? Yeah. Hooray. Every single portfolio company at scale, 20 VC or better be using AI by this point to make your product better. This is not 2023. You don't get any kudos for sprinkling AI dust on your product. Going to Rory's point, what you get kudos is attaching to that compute budget. That's the only kudos you get, and Duolingo didn't earn any.
Well, I couldn't, because to be fair, I'm just going to, as an apps investor, I'm going to step up and defend the poor little apps companies, right? If you're an infrastructure company, you can co-attach to compute. If you're a new AI apps companies, you are using that compute and using that AI. If you are like Duolingo and a lot of our companies that have been around since pre-AI, the question is, I don't think you're going to co-attach to the spend, but what you can do is co-adopt the technology. And I'm going to give Duolingo credit. They've done a decent job of saying, we're going to be AI forward, you're going to be AI leaning. But in the end, this is my zoom out point. In the end, you're still selling, you're selling a subscription product to help people, at a very modest level learn another language. Yeah, there's no AI compute to attach to there, Jason.
There is. No, they have to find a way. I mean, listen, I'm not a total Duolingo expert, okay? But Duolingo took money from, it does a lot of things, but in some sense, it took money from Berlitz and all these language schools and stuff online, right? Hooray, you did that. Now, where are you going to disrupt humans? This is your job. Like, you already disrupted those humans, unfortunately. They're gone, right? Where's the next level of human disruption?
Zooming out, I will give you that. That is true. I do think the next generation of companies that are going to be, quote, teaching a foreign language will obviously be LLM based. And there's a lot you can do. And, we've seen some of those companies do what I call more professional, more interactive teaching using LLMs. And I do believe there's a whole ton to be done in terms of one-on-one instruction in language and a whole bunch of other things. And Duolingo should be getting on its skates to do more of that versus just using, AI to, the thing they got into a little bit of trouble for the CEO was using AI to obviate the need for humans. The real question is, can you build a more compelling set of products using AI to do more immersive learning? And I think it's companies like Speak and companies we've talked to, I think there was a whole bunch to be done in AI-enabled learning, and it's actually a super interesting space, including language learning.
Really interesting question to ask for all investors, which is like, if you are not removing humans from the equation, you are going to be heavily discounted.
I think you should. That's the other. To simple, Rory's got a good point. You're either getting money from compute, right? This massive spend, or you're getting money because you're using AI to replace humans. Otherwise, you're not going to grow. Otherwise, hooray! Congratulations on your 14% growth. Where are you replacing humans for real? Whatever vertical, whatever industry, where are you going to go in and reduce the headcount that vendor needs by half?
Most of the time I'm in replacing humans is a story. Interestingly enough, in education, I actually think it's actually doing it better. I think the stunning data shows in a bunch of these education that, in fact, if the human today is someone in a class with 20 people, there's a whole bunch of examples that says LLM learning is equivalent to one-on-one human learning, tutoring one-on-one. What you should be doing with AI in education is allowing everyone to get something they haven't had, which is one-on-one learning instead of group-based learning, because all the data says one-on-one based learning, constructed specifically to your needs, is far more efficient way of teaching anyone a foreign language, and frankly, most concepts. There's been a bunch of
where does the and I'm not a total expert in education, but where does the budget come from for that software? If it's not replacing humans, then you better steal it from a legacy vendor, which is fine.
No, that's actually fine.
But Duolingo's a legacy platform now. Like you got to steal it. You got to steal it, or you end up Chegg.
Yes.
At least Harry didn't do Chegg.
I didn't do Chegg.
No, what I mean is, listen, you can use, so let's say your AI does not replace humans or attach to compute. You have a third option, which it's Captain Obvious. Your third option is to use AI to massively displace an incumbent and steal all their revenue. In fact, that's the history of B2B software mostly, right? Is stealing the revenue I just don't know how many of our public leaders are in a place to steal their own revenue, right? They're in a tough spot with it, with all their seats, right? And
agreed.
And we can fund those deals as investors, but I think the first two categories are much easier. Attach to the compute or replace humans rather than just steal. I mean, there's like 400 AI CRM startups out there, all saying they're going to eat HubSpot's and Salesforce lunch. That's not exciting to me as an investment. I'm going to go disrupt. I mean, maybe you will, but that's much less exciting than truly replacing 90% of your GTM team, right?
It's almost like doing customer support to me.
Yeah, I think that was a really good, Jace, that was a really good framing. You know, the fact that, you know, getting the new budget just so much better than trying to slug it out with the existing provider and say our new thing is better. It's not to say you can't in those spaces, but yeah. So I'm trying to
I would have to think education's got to be, it is an interesting market, right? It's large, but getting incremental budget has to be close to impossible. The public school district's not going to come up with another 10 million for your software. It's impossible.
Sadly, this is not a public school comment, right? Yeah. But you're right. Is that I think the positive sum comment is, I mean, I think Duolingo is actually what I call light learning. You know, you're learning another language, but you're just learning a few words. I think a really interesting space we've seen with LLMs is replacing the spend that an adult wanting to learn a second language, typically for business purposes, where hitherto they would do it with a one-on-one coach, right? So you're replacing that human coach with a very intensive, immersive, LLM-enabled learning program is actually quite a compelling market. But you're right, it's education, but it's not. But to your point, Jason, you have to find an existing spend, and the existing spend is pretty niche, which is people who can afford, you know, to spend money on a one-on-one tutor to learn a foreign language. So it's, yeah, there's not a whole ton of budget, unfortunately, in K-12 to give every kid a, you know, one-on-one customized tutor.
I love the way Jason's just getting better and better with every show.
Yeah. Just get him out.
Aren't you, Rory? I'm like, geez, he was here for the entertainment and now he's become
getting
so
hard
wise.
and mean.
He's so wise.
No,
what is going on?
I'm not mean. I just don't want to live in the past. And here's the thing. If you're in software today, B2B software, wherever you are on the, in an org chart or investor, honestly, if this isn't the most exciting time of your lifetime, going back to Sarah's conversation, you're doing it wrong. It should be one of the most stressful times of your lifetime. And we've talked about this, but if you're not truly excited, I mean, this is the first time software has gotten better since the three of us met. It hasn't gotten any better since all of us met. It's the same crap. So if you're not incredibly excited, again, going to the beginning of the Sequoia, I would retire from your VC fund, retire from your company. No shame in that. You had a great run, right? And just put the rest into NASDAQ and you're going to make more than most VC funds anyway, right?
I think it's a great point because, you know, as I think, you know, starting the 90s were X in client server and the last 2 decades were effectively, I always say Salesforce was rebuild Siebel in the cloud, and it was fun and we made a lot of money, but you're right, somewhat boring. What is really exciting now is you're not just talking about rebuild Salesforce exactly the same, but with a slightly modern UI. You are talking about something much more fundamental here in terms of eating the work and doing a lot more with the app. So yes, it is exciting, but looping right back to the first conversation about Sequoia, it is also clearly stressful for even the best of firms.
Right, boys, is there any other topic that we haven't covered that you think we should cover? I think one thing that is not in schedule that I just think is incredible is frickin' Hummingbird. Hummingbird, the fund that does not get credit, is not talked about in the same way that many other great firms are, does their first bio deal in 1 to 1. They have an $800 million position on the IPO. You want frickin' great venture returns. In whatever $150 million fund that is. Credit due. Amazing.
Agreed. Nothing to say.
Nothing to say, just like...
No, I mean, good for them. I mean,
what I didn't know, what I haven't, I was obviously incredible to see all the success. What I would like to know, and maybe we're out of time and I should have done my research, is how did they collect the capital as traditionally a seed manager, right? To deploy enough to maintain the ownership. Right. And I'm just obsessed with ownership now. It took me a long time to be obsessed with it. And now I've given up, but I don't see how I'll ever own 18% of something at IPO ever again. Right.
I think they were fairly capital efficient.
It could be that answer. It could be the Viva of biotech where they were one and done. I'm looking for that dream.
They definitely did put in subsequent checks, but I think it was a combination of doing subsequent checks and concentrating cash and being a capital efficient business.
Yeah, I'm impressed with the deals they've gotten into, maintaining the ownership with a nine figures of AUM. I don't know the exact numbers. That to me is just as S tier, right? Figuring that out. And whether it's a bunch of side funds and SPVs and VPSs or VPNs, just how you do that is I think the elite game today, right? It's hard enough to get into the deals, but with a 9-figure or 8-figure fund maintaining ownership is God tier, I think.
There's always the option of accepting, provided the follow-on rounds are at a high enough price, just accepting some dilution and optimizing, as you do, for multiple rather than ownership. You can say, look, I've established a 20% ownership as a seed fund. I mean, those early funds those guys had was sub $100 million. Okay, I'll get diluted from 20% to maybe 12% by the time we exit, but I put in $4 million. I'm a hero. Right. And,
yes,
I
this
think
was a YC
fund.
I don't think they started with 20, did they? But keep going.
Fundamentally, the way they've been able to produce 8 and 10x funds has been in part by, keeping it at 40, 60, $100 million funds. Obviously, if you want, it's hard to simultaneously keep your ownership and keep your multiple. You can decide which one you want to do. We talked last week is that, if you have Hummingbird, they've kept their multiple and gotten a 10, 20x, whatever it is. If you talk about someone like Lightspeed, they've kept their ownership in the van and gotten a 5x, but on $250 million. Both of them are great outcomes. They're just different ways to play the game. Now, the interesting thing is, both of them are different outcomes, have great outcomes for the GP. And this is where, if you only have $1, and this is the most important LP fact. If you only have $1 to play with, then obviously you want to do the one in the small fund that's going to give you the 10x, because if you have to deploy $100, then obviously you have to do the big fund. But to some extent, the high MOIC small fund, accept the follow-on dilution, but just make a marvelous return is the compelling product for the marginal dollar.
I agree. I think also the outcome sizes are interesting there. Navan at 4.5 now public, and billion to 1 at 5, and just the power of capital efficiency and bluntly running lean and not raising huge amounts of money. And you see the difference as an investor, like the benefits of investing in capital efficient businesses. Obvious statement.
Yes, we're Captain Obvious today. It's all good,
guys. I'm glad. It's nice to finish on a positive note, huh? And like a venture outlier that actually returns a huge amount of money to investors.
Yeah,
how nice. Thank you so much for joining me. I'm glad that you both approve of my shirt. This is not.
I am struggling with it, but I approve of it. And listen, how long are the pants?
He's got pants on. He hasn't got shorts on.
Well, they are jeans. They are jeans.
But let's not push too hard. He's at least wearing jeans. At least he's covering his knees. We'll take it as a win.
All right, guys. Fantastic. You guys are stars.
All right. Talk to you soon.